going on? What's going on? It's D Saul. Today, I'm going to be talking about calculating your DTI. Okay. I get this question all the time. What is a DTI and how do I come up with it? So we'll talk about it today briefly. Your DTI, your debt to income ratio. What does this mean? It means your monthly debt and your monthly income making a ratio to see how much of a home you can get approved, right? So when you apply for that mortgage loan, lenders don't only look at your credit score, they look at your DTI as well. So they're going to take how much you make in a monthly on the monthly basis, how much you're paying in debt each month, and they're going to come up with your ratio. Okay, so let's dive in. On this side, I got a few bills, and right here in this column, I have the monthly amount that gets added to your DTI. Okay, so let's talk about them a little bit in detail. With the credit cards here, you see I have a balance of 200 and 250, but we all get the credit card bill and we see a minimum payment due, right? That minimum payment due is what gets included in your DTI. So a lot of times is what, 25 bucks, 35, 40 or so. That amount gets included in your DTI for your credit cards. Okay. Now let's talk about loans, right? The loans are going to take your full amount that you owe that month, right? So in this case, we have an auto loan here for 400 bucks. That whole entire monthly payment gets included in my DTI. Okay. Student loans are different, right? All the time. Hey, D, I don't think I can get approved for a mortgage because I got too many student loans. Well, they don't even look at the entire balance, right? In the FHA, they only look at they used to look at 1%. Now they look at 0.5% of your balance when calculating your DTI, right? They just changed this rule last year. So what it basically means is you're going to multiply the balance of the student loans that you have times 0.5%. Okay. So in this case, a $50,000 student loan balance is only $25 getting included towards your DTI, right? That's awesome. So that should give a lot of people a little ease of anxiety that think just because they have student loans that they won't get approved. You can. Okay. So for mortgage here, I have zero, and I'll explain why I put that at zero in a second. Okay. I got $1,000 for rent and $200 for car insurance, right? These are in red because they do not get included towards your DTI, right? If the bill does not fall on your credit report, it does not get included in your DTI. Your DTI is only items that's getting reported as debt on your credit report, okay? So your rent amount, car insurance, cable bill, anything that's not being reported to your credit report does not get included in your DTI. So I got those, but they are not included in this balance here. Okay. So also I want to mention I put a medical collection and this charged off account here. This one is 500 and this is 100. Okay, I put these here because you can still get approved for a mortgage if you have small collection accounts on your credit report, right? So if you just want to pay off a few of them, get them paid off, and then you only have less than like $2,000 total derogatory balance, then you can still get approved for a mortgage loan as long as you fit within the DTI, okay? And with collection accounts and charged off accounts, most lenders typically only take 5% of the balance of those. So with this $500 medical collection, it's going to be 50 bucks. And for this charged off credit card at $100, they're only going to add $10 towards my DTI. Okay. So I got all of my totals, which is going to give me $535 total debt. Okay. So let's talk about the income. Okay. So if you're a W-2 employee, meaning that you get taxes taken out of your check each month, then this typically means you're a W-2 employee. Okay. If you're W-2, they look at your gross income. So they look at the income before they even take out taxes, right? This is another good thing because when they look at your income and your debt, they're only looking at the monthly amounts that you're paying. That's getting reported on your credit report for the debt. And for the income, they're looking at the amount that you make before Uncle Sam takes any of the taxes out. All right. So over here, we're going to put $4,000 monthly income. She makes $1,000 a week being a teacher. So $4,000 monthly income. So we got total income here of $4,000 and all of these bills excluding excluding the rent and car insurance and anything else that's not getting reported on your credit report, does not get included, we got $535. Okay. So now that we have this number, we'll talk about the DTI, right? So right now it's super low because the lender hasn't put in any mortgage payment. I'm going to get to that in a second, right? So the limits here, I tell everyone, if you get 36% or less, then you're good to go. Whatever type of loan you want, conventional, FHA, RD, USDA, all of that, 36% or less is your ratio, you're great. I tell people to aim for around 45%, right? It's a good, healthy number to be at, and your chances of getting approved are super likely at 45%. However, for the FHA back-end ratio, they can go up to 56%, and for conventional, they can go up to 50%, right? So let's just say 50% is that max you want to be at typically, right? But aim for 45% or less, and if you're under 36%, you're great. All right, so now let's go back up here to the mortgage. So what the lender is going to do once they got all of this information and your credit score, they're going to look at mortgage payment amounts. So let's just go ahead and just guess, right? We want Miss Teacher here to get a $2,000 mortgage payment. Okay, so when I put this number in, it jacks up my total debt at 63% DTI. That's high. So what the lender is going to do is adjust here, okay? What about a $1,500 payment? Boom, right? So now I put $1,500 in. It brings us a total debt at $2,000. We got that $4,000 income, which puts us around 50% DTI, which is good. So she may tell her client that her max budget is a $1,500 mortgage payment each month. Now, the purchase price in your area is going to change, but $1,500 should get you a pretty decent mortgage in plenty of states in the United States. Okay, so she's going to tell the agent, the real estate agent, she would tell me, hey, D, right, your client is good for whatever that amount. Let's say in New Orleans, $1,500 will probably get you around $250, $260, $270. So she'll tell me, hey, the client is approved for about $260,000, but that's her max, right? And she prefers to be around $1,200. So keep that in mind when looking for your house, right? So I'll get that information. I'll know what her max is. The client will know what her max is. She'll be able to, hey, Miss Lender, what if my payment was $1,200? What would that look like? She'll put that in. She'll put that in right there. It'll come up at 1735, and she's like, okay, I can deal with that, right? And that DTI is 43%, which is also less than 36%, right? If you have any questions, shoot me some comments below. Subscribe to my channel, Team D Saul. Follow me on Instagram. Follow me on Facebook. If you have any questions, leave those questions below. Feel free to share to a friend. Thank you for listening to my video today.